Hello and welcome to PTTV. Second wave of COVID has hit the nation even harder. In such a mess, what has kept the equity markets afloat? How come the stock market is hovering around its all-time highs? We have with us Mr. Kalpen Parekh, President of DSP Mutual Fund and AMC, which manages assets worth rupees 1 lakh crore, to untangle the stock market mystery. He also discusses important investment advice for new as well as existing investors. Let's hear him out.
See, I think markets fall when they are surprised. Uh, Likewise, markets also rise sharply when they are surprised positively. So the fact that when COVID happened first last year, and the impact, in fact, COVID news started spreading out in December. It's COVID-19, right? So in late 2019, everyone knew that COVID is there, but markets kept on rising till February. And only when India announced lockdown along with the rest of the world is when markets started pricing in the economic effect, economic side effects of a lockdown. That with these lockdowns, what will happen to industries, employment, consumption, profitability, and all of that. And this also, in a way, coincided with lofty valuations which were prevailing all through the last many years. When valuations are high, generally the assumption is the earnings will also catch up. But when lockdowns happened, it created that disconnect that the market is valuing for growth in earnings, recovery in earnings faster than usual. But on the other hand, the reality is markets cracked. Lockdowns happened. And that was one of the reasons why markets cracked. But at the same time, what also happened equally fast was collective action by all central banks around the world to, one, infuse huge amount of liquidity. Number one, keep cost of that liquidity very low, which is very low interest rates. And when these two things happen, generally there is incentive to look for risk assets to invest, and that led to a very sharp run up in prices again. When the same picture is playing out again, broadly the market is assuming that these lockdowns will not be as severe as last round. They are more either fragmented or in a phased manner, and to some extent, companies have also improved their execution, their profitability, their cost structures have come down, and on the other hand, liquidity continues. So one assumption that everyone is making is fine. This will also be temporary, like last year, and liquidity is enough to support on every correction. And central banks have continuously maintained their commitment to support all asset prices globally. So these are some dots that the market is joining like this. Now, this does not mean it cannot fall tomorrow. Like I, for one, continue to remain cautious in the way I invest my money or I guide our investors to say that the reality on ground is likely slow down, compared to the last quarter. Not compared to last year, because remember, compared to last quarter, numbers will be much better even this year because the base was very bad. So in that context, market is currently saying we'll look through this, and then there is this hope that with vaccination, things will normalize much faster. So market is relying on a couple of things as positive direction. One, the progress in earnings, the turning point in profitability. A lot of large sectors which were loss making for the last 3-4 years are contributing huge profits. Like metal stocks will contribute more profits than ever in their last in their history in terms of the size of profits. So the EPS will go up very fast, at least for the next 6 months to 9 months. On the other hand, this belief that with vaccination and more research, hopefully over the next 6 months to 9 months, we will be able to see control of COVID. So I think those are a few reasons why market remains optimistic.
So, in these chaotic markets, which sectors should investors look at and which sectors should investors avoid?
So, I don't comment on stocks and sectors because we are a mutual fund. We are not a company recommending stocks and sectors. So, my recommendation always would be to invest in a mutual fund because that allows investors to stay away from chaotic markets. Because if you try and go into one sector or few stocks, the concentration risk can be very damaging and the volatility can be very unnerving for investors who don't have the wherewithal to study all these trends, balance sheets, companies, annual reports, and so on. So mutual funds are a better vehicle for investors to always invest in, and within that, invest in diversified funds which invest independent of market cap. I always believe that the lens of investing should not be market cap based investing. The lens of investing should be around good companies or good prices or combination of both. So where can you get good companies in a portfolio, and they could be across market cap, they could be across sectors. And the second layer is at good prices, which means not very expensive. That dimension is a bit challenged right now because all prices are very high. And to some extent, to answer your question differently, which are the sectors where we are more invested in? If you observe most of our equity portfolios, uh, again, we don't take a sectoral lens that we like these sectors and hence we're investing. We take a company lens that, okay, these are the businesses, 30, 40, 50 businesses that are growing their profitability. They are surviving better than others. They are increasing their market shares. They are becoming more dominant. They are able to navigate or have the wherewithal to sustain through even few more phases of lockdowns. Such companies is what we like. So we have large weights in the top 3, 4 banks and NBFCs, because of which our weight in the bank and NBFC sector is large. We have large weights in insurance companies. We have very large overweights in cement stocks as a proxy to a lot of likely government support towards infrastructure over the next few years. We have reasonably good exposure to companies which are in the home space or which are supportive to real estate. So we call it fast moving electrical goods. Companies which are in the home appliances, home electrical devices segment. We like industrial and engineering companies which are profitable and highly capital efficient. So those are a mix of sectors. And then of course our core positions remain in technology and healthcare, because these two again are sectors where India has competitive advantages. Healthcare, we have the pharmacy to the world. We have solid companies at scale, and these two sectors don't need capital. They are cash flow generating sectors in a way, so they form a fairly large part of our portfolios permanently, not just at this point in time. So to just answer, we have not made too many shifts in our portfolio because of COVID. Because let me also tell you that when the correction happened last year, it moved back also so sharply that hardly anyone is able to react. When we manage portfolios to the size of 1 lakh crore, you can't swing your exposures very fast. So our thesis is build long-term portfolios and stick to that.
Okay, and any guide to new investors, because markets are almost at the peaks. So any guide to new investors where they should invest or how they should enter the markets, the mutual fund space?
Sure. See, markets every few years will be at its peak. Like every year, our age is also at its peak. I say this to everyone that our age is the highest every year, right? Every birthday, we celebrate peaks. But when it comes to investing, we look at peaks very differently. Either we get nervous or we get very greedy. So my advice to investors, old or new, is be disciplined, neither greedy nor fearful. Be disciplined in investing. Markets, no doubt, have run up ahead of their fundamental, realities and earnings, not just in India but everywhere in the world. What does it mean? Can you and I do anything about it? The answer is no. Markets have their own mind, and there will be years when they will run faster. There will be years when they'll run slower. But for us to preempt and predict which year they will run slow and fast is very difficult. It is all known in hindsight. Because that's unknown, no point in trying to predict or forecast that. So the principle that I would advise investors is keep long-term time horizons in mind. Over a long period of time, the leads and lags of the market will even out. Prices which have run up will normalize again, will not run up again, will normalize. In equity investing, keep one statement in mind, that there always will be fluctuations. There always will be corrections. Every 2 years, markets correct. Every 2 to 4 years, there is a 10, 15, 20% temporary correction. Corrections are temporary, and then up moves are permanent. So the direction over a decadal perspective is always higher, but in between there can be phases of low return or negative return. And to navigate that, have a combination of equity and fixed income in your portfolio. When you have a combination of these two, it smoothens your journey. It is like, starting to drive a car. You want to reach from, let's say, Mumbai to Delhi. You need the accelerator, no doubt, to drive fast, but you also need your brakes in between when you need to stop, pause, or slow down in a traffic road. So investing also needs accelerator as well as brakes, and of course the seat belts. So have a combination of these three levers. And in investing parlance, it is a combination of stocks, bonds, and gold. Have a diversified portfolio in a certain proportion. Have long-term time horizon. Ignore short-term fluctuations on the upside or on the downside. They almost mean nothing in the long term. So be disciplined. Be more excited when prices fall. Be less excited when prices rise very fast. Because when prices rise very fast, risk also rises. On the other hand, when prices crack, risk actually comes down. But as investors who are new, we may feel that, okay, NAVs are down 30%, should I get out? But actually, that is a time to add more. And likewise, when NAVs rise very fast, the debt component will help in rebalancing. So one suggested mode of investing for all new investors is to start with hybrid funds, is to start with dynamic asset allocation funds, not necessary equity funds, because they will constantly rebalance between debt and equity, and then gradually take you longer. And have at least a 7 to 10 year time horizon. Anything less than that should not come to equity, because if you take history, there are enough periods when even 5 year returns in equity as an asset class have been zero. So investors need to have a longer time horizon. Be more patient. When markets fall, increase your investment. But to increase your investment, you should have some money in hand. So which is keep your asset allocation intact, and that is a better way to navigate these type of volatile markets.